Have you ever really wondered how a bank actually makes money? I mean, they can seem like these incredibly complex, almost impenetrable black boxes. But what if you could just pop the hood, take a look at the engine, and actually understand what all those gauges on the dashboard are telling you? Well, that's exactly what we're going to do. We're handing you the keys. So here's our game plan. We're going to start with the bank's financial engine, the real nuts and bolts. Then we'll learn how to read its performance dashboard. After that, we'll crack open the profit-boosting playbook. And finally, we'll see how you can go from just analyzing to taking real action.
All right, let's start by popping the hood. We are going right into the engine room to see how money really flows through a bank.
You know, it all boils down to this one simple question. A bank doesn't sell a physical product, right? Its business is moving money around. And its profitability all hangs on a very simple balance: the money coming in versus the money going out.
This slide really lays out that fundamental balance perfectly. On the left, you've got the money coming in. The big one is interest income from loans and investments, but they also make non-interest income from things like account fees and commissions. Then on the right, you've got the money going out. There's interest expense, that's what they pay you on your deposits. There are operating expenses like salaries and tech. And then there's this really crucial one, the provision for loan losses. That's money they have to set aside for loans that might go bad, and it's a direct hit to their bottom line.
And when you look at where that revenue comes from, well, interest income is the undisputed heavyweight champion. It often makes up around 70% of the total pie. Sure, fees and other income are important for diversification, but the core business has always been pretty straightforward. Earn more on the money you lend out than you pay for the money you take in.
Okay, so we understand the engine now, but how do we know if it's running well? Is it humming along nicely, or is it about to overheat? That's where the dashboard comes in. We're going to look at the 4 key gauges that analysts use to check on a bank's financial health and performance.
Our first gauge on the dashboard is the net interest margin, or NIM for short. This is the metric that gets right to the heart of a bank's core business, making money from lending and investing.
So what NIM really means is it's the profit margin on that core business. A higher NIM is generally a good thing. It means the bank is earning a healthy spread. But, it's a really delicate balance. If a bank chases a super high NIM, it might be doing that by taking on riskier loans, and that can definitely come back to bite them later.
Next up, we've got return on assets, or ROA. This tells us how efficiently a bank is using everything it has, its cash, its loans, even its office buildings, to generate a profit.
And here's something that might surprise you. Because banks operate on such a massive scale, an ROA of just 1% is often considered pretty healthy. It's really a pure measure of how good the management team is at making their assets work hard for them.
All right, now for the gauge that shareholders are watching like a hawk, return on equity, or ROE. This measures the profit the bank generates for every single dollar of capital invested by its owners.
So how does a bank turn that kind of modest 1% ROA into a much more attractive return on equity for its shareholders? Well, the secret ingredient is leverage. See, they use other people's money, our deposits, to fund their assets. This magnifies the returns for the owners. It's an incredibly powerful tool, but it's also where the real danger lies. If those assets suddenly lose value, leverage magnifies the losses just as fast, and a bank's capital can get wiped out in a hurry.
And that very risk brings us to our final and absolutely critical gauge, the capital adequacy ratio, or CAR. This one isn't about profit at all. It's all about safety and stability.
Think of CAR as the bank's financial shock absorber. It's a capital cushion that regulators require them to have, and its whole purpose is to protect us, the depositors, from those unexpected losses. This creates this constant tension inside a bank. More capital means more safety for everyone, but it can drag down that ROE that shareholders love so much. It's the ultimate balancing act.
Okay, so we know how to read the dashboard now. The question is, how do banks actually move the needles on those gauges? Let's open up the profit-boosting playbook and see the strategies they use to get ahead.
When it comes right down to it, banks have 4 main levers they can pull. They can optimize their mix of loans and deposits. They can find new ways to diversify their income beyond just interest. They can be relentless about cutting costs, and they absolutely have to master risk management. The best banks are the ones that can balance all 4 of these at once.
This quote really just hits the nail on the head, because banks are so leveraged and often operate on such thin margins. Even a small slip-up in controlling costs or a few more bad loans than expected can completely wipe out their profits. Being efficient and careful isn't just a good idea, it's non-negotiable.
So you can really think of these levers as falling into two main buckets. On one side, you have your growth strategies, diversifying income, finding higher-yielding assets. And on the other, you have your efficiency strategies, controlling costs, mastering risk. The winning playbook almost always involves a really smart combination of both.
All right, for our final section, we're going to put everything we've learned together. We're shifting gears from just theory to practice. We're putting you in the analyst's driver's seat.
Here it is, a clear, actionable framework that you can use to analyze literally any bank. First, you gather the data from their financial statements. Step 2, you check the dashboard, you calculate those 4 key ratios we talked about. Step 3, you benchmark those numbers against competitors to see where they're strong and where they're weak. And finally, step 4, you use the playbook to propose a strategy for how they could improve. This is how you go from being a spectator to being a truly informed analyst.
So, we'll leave you with this challenge. Imagine you're in charge of a bank, and its profits have just stalled. What's your first move? Do you go after the net interest margin? Do you attack the cost structure? Or maybe the revenue mix? Look, there's no single right answer, but the point is, now you know exactly which questions to start asking.